Hi everyone, and thanks for tuning into another episode of Budget Investing. Today, I'm going to go over how dividends will make you rich and how to look at them and what you need to find within a dividend growth company to continue to always snowball and forever grow your money. So the first thing I want to look at here is if I zoom in really closely on my portfolio balance over here, on the left hand side, you'll see that my portfolio performance is around 8.37%. For me, that's fantastic as I know the market typically grows in around that 6 to 9% every single year. So if I'm floating around that 8.3%, I'm sitting pretty good for doing this all by myself. Now, if I actually take those dividends that I've received over this last calendar year and I remove them out of my portfolio's performance, you can see that I drop almost 2% in total growth in my portfolio. So that means in those ups and downs, I just didn't gain it. But those dividends that I received, I was able to reinvest them into other stocks and continue growing my portfolio. So it's just an addition to my overall portfolio and it's just helping me grow and snowball my money in the long term. So for the long term, my plan with dividends is to continue obviously making money out of them. But if I look at it in a slightly different way, so for 2020 I made, let's just round it up and call it $60 for the year. Already in this calendar year I've made $110, so about $170 total. That's $170 that I've received in dividends that I don't need to worry about. That's money I get to put right back into my portfolio. And another way to look at it is that first $170 worth of stocks that I've purchased, they're now free. I can take those stocks and sell them. It's just free profits. Now, the longer that I hold these individual stocks, the more money they're going to make me, and the value or that dividend yield that they're paying me is going to, in essence, continue to increase over time. So let me show you an example of that ever-increasing dividend yield while the company in themselves isn't necessarily paying a higher dividend over time. So how do I continue to grow my money and continue to get free money? The way you're going to be looking at it is that yield on cost with a company that you purchased. So your hope is that this is a dividend growth company. What that means is that every year they're continuing to increase their revenue so that their share price is increasing, as well as they're paying a stable and ever increasing dividend. Now, if a company were to do that, say for example, the one that I'm looking at here on the screen, if I bought it 10 years ago, back in 2011, the dividend price would have been around that 2% mark, and the specific cost of the share was in and around $30 per share. Now, if I would have held that this whole time, let's just say I bought one single share. Today, when they give me my quarterly dividend payout, that works out to be about 21%. That's a 21% yield. Now, that is insanely high, and you're probably thinking, no company in the world is going to pay you a 21% dividend yield. That's not sustainable. That company is going to run out of money in no time. Now, this company isn't paying me a 21% yield. They're paying around a 2% yield. Now, how does that work? Every year, this company is making more money. They're increasing the price of their share, and they're increasing their dividend payout every year in and around that 10 to 20% range. Now, the longer I hold this company, the more increased value in that yield that you'll see. But if you look as I get closer and closer to today on this chart, the yield that I'm actually getting is kind of dropping over time. Of course, you'll have this little blip here 1 year ago, that's COVID, but you go all the way up to today, we're back down to that 2% yield. What company is this? This is Home Depot. So how do I capitalize on this? First bit, I of course look at their dividend summary. Now, of course, Home Depot, they pay out 47% of their free cash flow. They've been growing their dividend about 20% every single year for the last 5 years, and they've been growing their dividend for 12 years. They're still only paying me a 2% yield. But if I hold this dividend for 5 years, 10 years, 20 years, maybe even 30 years, and they continue to grow their dividend 20% every single year like they have been for the last while, all of a sudden my money is going to be working super hard for me, and I'm just gonna start to snowball like crazy. I'll take all those dividends that they get me, I'll reinvest it, buy more stocks, and I'll just continue to make more money. Now, where this really starts to snowball for me is on top of the dividends that I'm going to receive, I'm also going to have the capital appreciation of this company because, again, it's a dividend growth company. So they're still growing, they're trying to grow their capital worth and their money every single year. So if I look at Home Depot still, again, I buy this 10 years ago, it's worth about that $30 range. But if I move it all the way to today, it's worth $316. That's a 764% increase on my gains. Now that's fantastic. That's a ton of money. And then you factor in any dividends that I received over the course of that time, and I'm looking at a ton of extra money. Things are really starting to snowball. I can continue to purchase more and more stocks or sell out of this, take my profits, move it elsewhere, or live on that money. The choices are, of course, endless, and I can do whatever I want. But this is where things really snowball for me. So I'm just going to show you this chart again. I know you've seen it a few times, but again, if I were to continue adding $200 every single month for the rest of my working career, I'm only adding about $93,000, $94,000. I'm going to get close to $1 million in growth, but I get almost $500,000 just in dividends. Now, that's a huge amount of money. If I take that out of my entire portfolio, that nest egg that I would have, that 1.5 million, is significantly smaller. You also need to remember that if I don't have that throughout this whole time that I'm investing, the compounding effect is really going to slow down. So let me show you that. So again, I have 1.49 million right now, but if I were to remove all the dividends that I'm going to receive, you can see it drops down to $600,000. So we're talking a small amount of money, but over $800,000 over the course of 44 years. And again, I only received $500,000 in dividends, not even $500,000. So that just goes to show that I was able to buy more stocks and continue to get that growth. I get to hold things for a longer period of time. So you're probably thinking, okay, that sounds amazing, but how do I find a company like Home Depot, whether they're worth, $20, $30 a share? I can't really afford to buy into Home Depot in around that $300 price, and Home Depot's probably not going to go up another 700% in value. They're not going to jump up crazy amounts anymore. They're probably pretty close to their peak. They might continue to go up, but they were not going to have crazy jumps like that anymore. So let's take a look at my screen right here, right now. The company I'm looking at, they're paying a very small dividend yield of 0.66%. The payout rate is, 24 cents. It's nothing crazy. They're only paying out 10% of their money, but they're growing at a 21% rate every year, roughly. And they've been doing it for 12 years. Sounds pretty similar to Home Depot. Now, this is a totally different company. It's Almanation Touchard. Now, this is a company I've talked about in previous videos. They are undervalued. Their PE ratio is around 18, while the rest of the market is floating around that 20 to 30 range. They are continuing to grow. They're making fantastic acquisitions over time. This is a company that you've all probably used. You've heard of Circle K or the Max convenience store, and they have gas stations, and they're very large, they're very diverse, and they're growing internationally right now as well. And they're trying to get electric vehicle chargers on their buildings. This is just a company that will continue to grow with you. Or this is a type of company that you should look at, someone that's paying a very small dividend yield today, but they're showing that high growth in their dividend over time, and it's a company that's being aggressive for their growth in the long term. So again, I like to come back to this chart. It lets me see where my money's sitting and how hard it's working for me. So again, those companies in that low yield, I have a very high percentage of my portfolio, 50% there. And 29% of them are growing greater than 10% every year. I've got 20% in around that 6% growth, which is still fantastic. That entire portfolio balance, I want them growing as much as I can. 35% of my portfolio is growing faster than 10%. 44% is in and around that 6% yield, and about 18 of my portfolio is low growth, so people that are just straight up income that I'm using today. I am using my current money that I'm going to be investing to take and add it to the high growth areas. I don't want any more low growth. I have time. I want my money to grow and snowball in the long term. So this is how I'm using dividend yield and dividends to continue to grow, and I know I'll retire with a ton of money and I'll be super rich at the end of the day with all of these dividends that are going to help me snowballing my money. Hopefully this information that you saw today is going to help you to snowball your money and use dividends to help you get rich in the long term. If you enjoyed it, please thumbs up the video, comment in the comment section so that I know that you're enjoying it, and is there anything else you'd like to see or hear about? And please do subscribe. I'd love to continue growing this community that we have here. Otherwise, thanks so much for watching, and I will see you in the next video.